My guest today is Professor Jörg Rocholl, who is the president of ESMT Berlin. His research interests are in the areas of corporate finance, corporate governance, and financial intermediation. Welcome, Jörg.
Thank you very much for having me.
Yeah, thanks for doing this. So I want to start with one of your older papers. I found that really interesting. Do politically connected boards affect firm value? You say this article explores whether political connections are important in the United States. The article uses an original hand-collected data set on the political connections of board members of S&P 500 companies to sort companies into those connected to the Republican Party and those connected to the Democratic Party. The analysis shows a positive abnormal stock return following the announcement of the nomination of a politically connected individual to the board. Yeah, so this is very intuitive. I guess this is a paper from 2009. Things have probably gotten more robust in this metric. In the US, as you know, we increasingly have nobody in the middle. We have blue shirt wearing Democrats and red shirt wearing Republicans. They don't seem to like each other that much. So it's a very divided country. But I guess the observation here is that any connection to a party in power, I want to understand this. So in the US, we have the Congress, the Senate, and the president. Oftentimes, they are from different parties. And so there are two questions, right? One is sort of anybody connected generally in the political arena. How does that affect firm value? And then if somebody's nominated from a party that's in power, how does that affect firm value, right?
Right. So the main question we wanted to answer by starting this research project is whether political connections can create value, even for US companies. So there was evidence before for countries such as Indonesia, for Brazil, but one could argue that the legal rules in the US are much stronger than in these countries. So therefore, it was of our interest to see whether in a country which has very strong financial markets, which also has very strong financial oversight of markets, which also has overall a very strong legal system, you would still see these reactions. And so therefore, we classified companies based on their board of directors into those leaning towards Democrats and those leaning towards Republicans. So this basically, you could say, was challenge number one, how to classify a company as being politically connected or not. And the second challenge is then how to measure it. And we used, as you said, two types of events. One was what happens at a point of time when a politically connected director is added to a company. And the second one, that is maybe even the more intuitive one, is what happens after a highly contested election. And we used, for example, the presidential election in 2000, where it remained unclear for actually a couple of weeks which party actually would win the election. And we found then that with each step that made it more likely for the Democrats or finally for the Republicans to win the election, that also the stock price reactions for the Democrat or Republican companies became positive or negative dependent on their connections. So therefore, it is important to find an event, and it was important to find an event of which there was really a news coming out, new information coming out with the uncertainty regarding the outcome of the election going down. And thus, for this event to become, you could say, the crucial point for our investigation.
Yeah, I mean, it's really interesting. I mean, these are large companies, this is S&P 500 companies, and an abnormal stock return would imply that we are talking about very large amounts of money, hundreds of millions of dollars, or even billions of dollars, right?
This is right. It obviously depends, and there's also variation across these companies, what it would mean for them. But these are definitely significant amounts of money that are related to that, which obviously it's something we can discuss later, led us to the second question, where does this come from? And obviously, I'm happy to go into this in more detail to come.
And so I don't know if this is in the data. So this is some sort of an event study, right? So you look at, when something happens, what the expectation was, what the abnormal returns are. But over time, does it normalize back? Or is this sort of a permanent change in firm value?
So obviously, there's a lot that is happening after the election. Lots of changes affecting the companies. There are also papers that look into more long-term returns. Here we concentrate just on the short-term reaction, given that in order to take a more long-term view, we would have to take into account many other events along the way. So therefore, it is really an event that just looks at short-term reactions to the announcements of the election results.
And the board's composition, so one person politically connected as opposed to 2 people, 3 people, is there a difference there?
Not really. The most important part is really for a company to be connected and to be connected to the right party. So this means to the party in power. What is obvious, though, is and becomes evident from the data that companies that are most highly dependent on government procurement contracts, they actually tend to have connections to both political parties. So it seems to be very important to those companies that generate a major fraction of their revenues from government procurement contracts, that they need to insure themselves against whatever the outcome of an election might be, and thus to be hedged against either outcome.
Yeah, so you have another paper on that, politically connected boards of directors and the allocation of procurement contracts, as you mentioned. And you say the article analyzes whether political connections of the board of directors of publicly traded companies in the US affect the allocation of government procurement contracts. So these, I suspect these are like defense, space, things like that, right? Big contracts.
Right, that's exactly right. So we see in particular in the defense industry that procurement contracts play a major role for those companies that actually produce these goods. And this is just one way in which we envisioned at the point of time we finished the first paper, these stock price reactions could come from. You could, in principle, think of many ways in which politically connected companies can benefit from politicians. When it comes to regulation in various parts, when it comes to, and this has been found for other countries, when it comes to, for example, government loans from the likelihood of being bailed out in a crisis. Also, when it comes to thinking about import-export tariffs, whether there are exemptions that can be used for yourself, for your competitors. And we thought of government procurement contracts as a really clean example, given that they are significant. These are multi-billion dollar contracts that some companies generate and receive. And thus to see a change in the contracts and the volume of the contracts would have immediate impact on the cash flows of the companies. And in that sense, it would be a very clean example of what changing political relationships vis-a-vis the governing party could actually result in.
Yeah, so this is clearly not a meritocracy. and it's a common practice in the US, as you know, large companies contribute to both parties equally. And so this is sort of a hedge. They can go back and influence, if influence is the right word, on policy, on contracts, either case, either party gets in. If they contribute to both of them equally, that's a good situation. And I guess the board composition in that sense also, right? Perhaps the directors are coming from both Democratic and Republican connected individuals.
That's right. We look at both components because there are obviously also different ways in which you can measure political connections. The donations we looked at, But as you just said, donations seem to be much more fluid than board connections. This has to do with the fact that one election campaign or one election term, you can donate to the one party, in another one you can donate to another one. What we seem to sense from the data is that there is a strong tendency also to follow who is most likely going to be the winner in the election. So therefore, nominating a connected board member to your company is actually a much more powerful signal. It's also a much more, you could say, enduring signal, given that you can't change it so easily. And thus, we concentrate more on the board connections as the level of political connectedness than the donations.
Yeah, so I want to take a bit of a detour and get your perspective on this. So scale-based advantages appear to be increasing in every industry. For example, I thought 6 or 7 companies command maybe 30% of S&P 500 capitalization today in the US. So when companies get really big, they have a lot of advantages, obviously, from an operations perspective, very obvious advantages, but also patenting. They have thousands of lawyers on staff that continuously manufacture patents or get around existing patents. And this appears to be another scale advantage here, right? They can go out and get, the best connected individuals on the board or in their exec committees and so on. Do you see that as an issue? Does this reduce competition, more generally speaking?
It certainly raises serious questions about competition, given that there is not an overly abundant supply of those politicians who can help the companies. So there's, if you will, it's an asset for which there's also competition among companies. And what we find in our data, for example, is that the first nomination of a politically connected individual shows or exhibits much more significant stock price returns than, say, the second or the third appointment of the same individual. So this means there's a certain novelty that comes into play, and a certain novelty that really makes a difference in the stock price reaction. So this means individuals and thus also companies will choose very carefully which company, which individual should get together. And thus it could be the most highly capitalized companies, those that have also most to lose, to secure also the most say talented and most influential politicians on their side, which might be much more difficult to receive for smaller companies. So in that sense, this is certainly something that could add to the tendency you just described.
Yeah, it's sort of a bidding process for the assets. And it seems like the marginal benefit derived by the company declines as it gets more and more of these types of people. So if there are 2 people at dinner making a deal, but there are 3 people or 4 people, doesn't appear to have a big impact on the outcome.
Yeah, that's exactly right. And it's in that sense the novelty of a person, or the novelty of the exposure, the context a person brings to the table is important. You could say that it is also maybe a question of trust and trust building that a former politician has. So if the former politician comes to the table first to bring forward one item that is relevant to a company, then this person may still enjoy a higher reputation, a higher level of trust than coming to the table the second time with another company and maybe another topic. So therefore, this novelty and the impact of this seems to be relevant and of material value.
Yeah, I was wondering, George, so the even studies are sometimes done to look at insider trading, other sort of things. From a policy perspective, if we are seeing this in the data very clearly, isn't this sort of a problem from a legal perspective? I mean, if the company is gaining $100 million, I'm just making up a scenario, by appointing a a director who's politically connected, it clearly implies that there is, I mean, this is not really, isn't it a clear evidence that something bad is going on?
Not obviously. It could be. However, it could be there for completely innocuous reasons. The reasons could also be not so innocuous. And this is now the big challenge. And let me just make maybe both cases. The reasons in which this has to be watched very carefully is obviously if there is corruption, bribery, and other parts involved, the dark channels of money. At the same time, it could be something in which companies can benefit simply from the expertise that a politician brings to the table, and in which I think it would also be a good thing to have revolving doors between, say, business and politics, in which there's, say, mutual utilization of knowledge, of expertise. So therefore, it's very hard to find, say, an answer that has, so to say, a one-size-fits-all. However, it raises very important questions for, first of all, transparency, so that it's very clear what is happening, what someone did. And it could also trigger, and this is what we see in many countries, it could also trigger important reasons for cooling down or cooling off periods, in which those who have a certain duty are not allowed to go, say, to a company or another institution that could benefit right away from the inside knowledge. So, or at least there are certain rules which would not allow for the transfer of knowledge. Say, if you are the defense minister and you right away join a defense company. So it might be different. Say, if you are the defense minister and you go to a company in the agricultural sector or so, where it's less about specific knowledge, but rather maybe the broader expertise and contacts.
So I know that there are some constraints on lobbying. For example, if you are if you're in the Congress or the Senate and you're retired or just gotten out, there's a period of time you cannot really lobby the Congress and the Senate. Do such constraints exist here for directors of companies?
There are different types of constraints that different countries have imposed on former politicians. And this is always a matter of also, say, recent events that may actually trigger new debates on whether this should be strengthened and this should be brought forward. And this is where, say, the legal background is quite different also in different countries. Where you also have a debate. And I'd like to make maybe this point in comparison to the United States, where I did my research, and Germany, where I live. So here in Germany, there's a lot of complaint about the lack of the revolving door between business and politics. And the argument here is often we would need more businessmen or women to join politics, as well as we would need politicians to join business, simply to learn from each other and to actually inspire or instill new knowledge on both sides. And so therefore, the answer of whether it's good or bad is very difficult in my view to answer. But what we need are really definitely very clear rules. And as I said before, foremost, we need full transparency about what is happening so that really everybody can make a judgment on this.
Do you have some sort of a comparative measure between EU countries and the US, both in terms of this happening as well as sort of the legal framework or constraints exist in this arena?
This was not part of my research. At the same time, it is, I mean, there's some elements that are important in this context. First is that the United States capital market is a much bigger and stronger one than the EU capital market. And in particular, we still in Europe have to face the situation of a rather fragmented capital market. So therefore, the gains here are often limited to rather national stock markets and not a really as strong and wide capital market as in the United States. So this is one. Second, even though we have obviously different levels of, and you mentioned this before, different levels of political decision making, this might actually be even more, you could say, tricky in Europe, where you have decision making on the European level, you have decision making on the national level. Then, similar to the United States, you have decision making on the federal level. So therefore, it might actually be even more important to target the right source, rather actually being more important than in the United States.
So if I understand this correctly, then would you say the constraints that exist because of the overall EU decision-making and country-basis decision-making are quite different? Would you say that the overall constraints that exist are higher in Europe in this type of a process?
Yes, I would argue that this is the case. And in particular, reflecting on what I said, that we see, and there might be other reasons playing into this, but for sure, seeing the often made claim that we would need more of a revolving door than we currently see it, and where the US is actually taking as a positive example, despite all the challenges that we discussed before.
And the parliamentary system, and I'm thinking, do you see a difference in UK, or it looks approximately the same?
Yeah, this is also a very important point, given that we obviously also look at different ways in which members of parliament make it to the parliament. So this means if you have a clear majority rule system where you have competitors in one jurisdiction fighting against another candidate in the same jurisdiction, it's a very clear election of who will win or will not win. In a system such as the German one, where you also have, in addition, you also have the so-called lists. So basically, members of parliament and candidates for membership in the parliament become part of the list, and then it depends on how much or how many votes a certain party receives. Then also the whole nomination process follows different criteria, and also the way in which support for individual candidates will be amassed will be different in the German system, say, than in the UK or the US system.
Yeah, I remember, when I was growing up in India, when after the elections, one party essentially takes over the entire government, and increasingly that's not the case in the US, because there is, a Senate and the Congress and the president all could come from different parties. So that system, at least on the surface, appears to be less problematic than a parliamentary system where the lower house, if it has good majority in the lower house, essentially going to make all the decisions without any sharing of power.
Absolutely, and this is, I think, a very interesting research question in itself, where I've just seen new papers coming out that look at the checks and balances that different political systems have. Whether, for example, you have a more diverse representation of different political interests in the political system, whether this can actually help economic efficiency. And while it might be too early to see what exactly the outcome of these research papers is, I think they are extremely inspiring and rewarding. I mean, it's very rewarding to follow up on this research. So to see whether checks and balances, additional checks and balances, actually, in fact, can increase economic efficiency, because you may also argue, well, it's much better to not have them, because it's much easier to make decisions in this case. But it goes, you could say, in a certain way back to the old literature, even in, say, Latin Republican law by Cicero, for example, where the question is, what is the best political system you can imagine? Is it one in which you can have a very strong power that makes all the decisions, therefore to make quick and easy ones, but at the same time risking huge disadvantages if things go wrong? And therefore the level of, when it just comes to economic outcomes, to understand the level of political diversity of checks and balances there on economic outcomes is a very important one.
Yeah, I'm a big fan of distributed decision making. I have fantasies of direct democracy. With technology now, can we move away from this political intermediaries who tend to get corrupt or in some cases incompetent. Actually, a lot of these decisions are fairly technical in nature too, that politicians are not really equipped to do. And so do you see with existing technologies that are highly distributed, everybody has access to the internet and so on, do you see over time we can move toward more of a direct democracy system?
That is certainly an option. So the technological advancements certainly make it much easier to go that way. At the same time, it requires also a very profound decision-making ability by those who are able to vote. And I always look at this with some admiration in Switzerland, where we see that some of these stakes are up for general vote. And what I see at the same time is that people, citizens, spend significant amounts of time to prepare themselves for such cases, because then it's not longer possible to simply delegate decision making and getting informed to representatives, members of parliament, but you are really in charge yourself. So be it shall a new swimming facility be constructed in your neighborhood or not? Because that certainly has a certain, and this is certainly what economists would call trade-off. On the one hand, you have the benefit of now being able to swim very close to your home. At the same time, you must also understand that this may come with a cost. So, for example, that local taxation may be raised, and this type of trade-off is really what people would then have to take into account.
And I don't know much about this. How about the Scandinavian countries? So clearly there is a size issue here. So when you're less than 10 million in total population, you probably have more options around structuring a system that's different from large countries. Does Scandinavian countries, Finland, Sweden, any of those have any different systems?
So we haven't researched them, but what we certainly see is that here it also comes into account how countries structure themselves. And this is also actually maybe one of the fundamental principles by which the European Union has been established. So when you, for example, see that by founding principle, it should be that whatever can be governed at the local level, it also should be governed at the local level. So that only questions of national and maybe also transnational importance when it comes to defense, for example, or the internal market, that they are then governed at the national or the supranational level. So you could say in that sense, the question of which decisions are given to which level is of crucial importance, as they would allude or they would go in the direction of where most competence is coordinate or is existing to be able to coordinate these decisions.
Yeah, I mean, one complication though is that if states have different decisions or different systems on large issues like healthcare, education, and so on, it could create a bit of chaos, right? So I'm thinking if Illinois and Ohio have completely different healthcare systems and healthcare policies and so on, that could create an issue too, right?
Absolutely. This is a possibility. At the same time, when you think of, in Europe, this is often referred to as the subsidiarity principle. At the same time, if this is in place, it also may raise a certain level of competition, which might be good. So given that no one knows or should know or can know everything about everything that may happen, so given that we live in a world with, you could say, incomplete knowledge, also incomplete contracts, so not knowing what is going to happen going forward, that rather it should be a good idea to be able to experiment a little bit on certain parts, see what the outcome is, and then maybe also learn from others who have done better, and also obviously learn from those who have done worse to avoid those steps they're taking.
Yeah, topically, COVID-19, we have 50 different experiments going on in the US in terms of how to counteract COVID.
Same here. Same here.
So I want to go into another paper that you have, Institutional Investors and Corporate Political Activism. You said a landmark decision by the US Supreme Court on Citizens United versus Federal Election Commission asserts for the first time that corporations benefits from First Amendment protection regarding freedom of speech in the form of independent political expenditures, thus creating a new avenue for political activism. So you are saying here this is actually a good thing for companies to have this flexibility?
Well, we are first only documenting the huge increase of political donations following this landmark decision. So we see that there is so much more money flowing into the political system than before. And this seems to suggest that, first of all, those who give the money to the system, in fact, think that there is a value to be gained from investing there. At the same time, we also see right away, from basically from day one after the announcement of the decision by the Supreme Court, you see also the criticism to start coming in. First one being that now big business seems to dominate everything, so that now big business may find it even easier to influence political decision making in their own interest. And at the same time, and this might be actually the most surprising part, is that also big institutional investor associations warn companies against using this freedom, because they are afraid of a lot of waste of money in this case. So that this is not really driven by, say, rational decision making, but rather that there's a lot of waste of money. And that may go back to an earlier paper, say 15 years ago, that looked at political donations or contributions and the stock returns of the companies. And there you find, but this is a pure correlation, there's nothing about causality yet, the pure correlation between the well-being of a company as measured by its stock price and the amount of donations these companies provide to the political system. And now you can make basically most cases. You could say, on the one hand, if a company gives a lot of donations, then it's also going to be more successful. But you could also make exactly the counter argument. Only successful companies with a lot of money can even afford to provide political donations. So therefore, the latter part is the one that is probably of a lot of concern to many institutional investors, so that they basically try to avoid and actually try to penalize companies they invest into from investing too much in the political process.
Yeah, I also wondered, in a system that is sort of very finely balanced, almost 50-50 between two parties, one could argue that the expected return on contributions are lower, right? I mean, you have that probabilistic outcome of who is going to be in power that is not necessarily very highly predictable. And so either you have to go in with a lot of contribution on either side, just sort of hedge both sides of that. Whereas, in a very dominant political party country like India, for example, you can predict who is going to be in power, probably with fairly high level of accuracy, that the returns on that donations probably is a lot higher, I would think.
Yeah, and it's, I mean, this is why we also looked at different elections in our own research, given that there were some elections in which it was pretty clear who would win. The outcomes are pretty different from an election as the one that I mentioned in 2000, where even after the election it wasn't clear who won it. And therefore, these patterns, let's say, if you compare to the 92 or maybe in particular the 96 election, is quite different, because you then also see, you could say, tactical behavior by companies that seem to have donated much more to one party now, say out of tradition or say political beliefs, now seem to also go around those parties or that party that seems to win most. So therefore, these are pretty balanced. It's a pretty say sophisticated way in which companies do this. At the same time, I think also the parties know that a donation, as useful as it might be for a certain election, is not, say, a forward-making statement about real political connections a company may have.
Right, right. So I want to go into another paper that's a different topic. Do credit shocks affect labor demand? Evidence for employment and wages during the financial crises. You say we studied the impact of exogenous funding shocks to German savings banks during the US subprime mortgage crisis. So we're talking about the 2008 crisis?
That's right.
Or the labor decisions of 30,000 private and public firms in Germany. You said we find that firms with credit relationships with affected banks experience a significant decline in labor demand relative to firms with credit relationships with healthy banks. So labor demand meaning they are hiring less people as opposed to other banks hiring more.
Exactly. So labor demand meaning the demand by companies for workers, for employees. This is specifically driven by the fact that also Germany, while it was in healthy economic conditions, was significantly affected by the financial crisis due to the fact that some banks, but not all banks, and this is actually the trick we use in our experiment, that some banks were heavily invested in the US subprime market. So therefore, when the US subprime market collapsed, some banks in Germany were affected by this collapse of the subprime market. Others were not, simply because they were not invested in the United States, or at least not to the same extent. And thus, we can now look at what happens to the credit relationships of the affected banks versus the non-affected banks to their industrial corporate customers, and then see whether this lack of credit supply the affected banks provided also leads to then a lack of demand on the company side for in the labor market. And this is indeed what we find. So that means that an event that started in the United States that at first place had nothing to do with the German economy led via this transmission mechanism to also a lower demand for German workers and employees. And this actually type of research also has been shown in other contexts. So for example, it also has been shown in the other way around, US companies, US workers being affected by certain changes that had its origin or their origin in other parts of the world, be it in Japan or other parts of the world, and thus showing, you could say, the global linkages that we have for markets to work together.
But the industrial clients of these banks, if they don't, let's say, the company was a kind of the affected bank, they could switch banks, couldn't they?
Yeah, they could, and this is certainly something that mitigates this problem. So this means if they also have relationships with a non-affected bank, then this obviously is a very nice hedge for them to get out. But in many of these cases, if there's only one bank that they have worked with, and maybe have worked with one bank for good reasons, because the bank has known them very well, they've understood, they've built a lot of information on this client, that this effect then would have more severe effects on this company if it relies, or more or less if it has put all its eggs into one basket.
Did the prices spread, again, looking at Germany, were there a lot of bankruptcies in the banking sector?
Right. So the the financial crisis had severe impact on Germany. So in particular, in 2009, Germany saw the worst decline in economic activity since World War II. So it was a GDP decline of about 5%. And that also led to a massive problem in the German banking sector. So we saw a number of bankruptcies, but in particular, a very strong consolidation of still existing banks, where, say, weaker banks were acquired by not so weak banks in an effort to consolidate those weaker banks.
Do you think this experience, this sort of a systemic shock that spread across the world in 2008, do you think we learned sufficiently from that to avoid it in the future?
So first of all, I would say yes, we learned a lot. So when you think of all the regulatory responses, political responses that came out of this crisis, then we definitely can say a lot has changed. The regulatory response reaches and has reached financial institutions all over the world. It was a very concerted effort by policymakers, politicians, central bankers, also fueled by academic insight that actually has led to a new oversight. Whether this will be sufficient for the next crisis is a question that remains open because we simply can't foresee what the next crisis may look like. So, for example, in 2008, 2009, no one would have foreseen, say, the pandemic crisis to be the next one that would challenge the banking, the financial system, even though the problem here definitely did not come out of the financial system, but rather where the financial system needed to help stabilize the effects that came due to the pandemic crisis.
Yeah, so as the economies get more and more integrated, in some sense, you lose flexibility, right? So, we saw a lot of supply chain disruptions, and the shock can spread through the system really fast because it's all very well integrated, very well connected.
Yeah.
Do you see that as a problem for the future?
Yeah, it is certainly a big question at this point of time. So when we think of, in particular, the global supply chains, the global supply chains were taken for granted for a long period of time. Companies actually, in terms of seeking more efficiency, try to expand their supply chains even more on a global scale. And now we see a little bit of getting these supply chains back home. And that certainly is at the loss of economic efficiency, but it certainly also involves a certain insurance argument that you would like to be insured against the potential risks of something like the pandemic crisis. And maybe relating it back to my earlier papers we discussed, also maybe the political risks that may come with it. So in Europe, there's certainly a lot of debate on the so-called decoupling, that there might be a risk at some point that European companies may have to decide between a Chinese-dominated part of the world and a US-dominated part of the world, in which maybe two different production cycles, two different supply chains might need to be in place in order to deal with these different political and politically divided systems.
Yeah, so my understanding is that the labor cost arbitrage was one of the sort of the driving force toward going abroad. But as robotics, artificial intelligence, new technologies reduce the labor content of products, do you see things will get more and more localized? What do you see from a trend perspective there?
Yeah, that could be an argument. At the same time, we now also see different types of, say, globalized activities, which may lead, or let's say, which may benefit less from arbitrage in prices, but rather might be driven by access to markets. So this means there are different trends going on at the same time, which may go in the one or the other direction. For sure, I would say that, say, an unconditional belief in making supply chains more and more global, also product chains more and more global, has been definitely been reduced by what we've seen in the pandemic crisis. And we now see a certain readjustment of these processes, and maybe also separation into, say, more globally and more, you could say, regionally oriented chains.
So in conclusion, I want to sort of finish up with the first topic that we were discussing. So do you see any sort of policy intervention to, supposing these sort of connected boards and allocation of procurement contracts and so on is reducing competition, may not be good for the economy, may not be good for medium-sized, small companies? If that is true, do you see any sort of policy intervention you can put in place?
I would see this policy intervention in the most general sense by the antitrust authorities to take on their role more seriously. And we have seen this from the debates in the United States. We also see it from the debates here in Europe, that antitrust is probably, again, at the peak of public interest. So, and we see it, even though, in my view, this is a misguided argument, but nonetheless, the argument is there, that the argument is made that even the current inflation might be driven by a lack of competition. But for sure, we see that argument also, also documented by academic evidence, that for example, the margins may change in certain industries based on the lack of competition, so that you see, say, takeovers reducing the real competition in a given industry.
Yeah, so the antitrust, I don't know much about this, but in the US, because of the, the lawyers, the legal power that these large companies can bring to the table, they appear to be very successful in delaying any action that comes from. So, even if you bring a case against them, it's a 10 years, 20 years before anything is done. So I don't know if the existing laws are sufficiently robust to go after these types of issues.
This is definitely a case to look at. So whether, say, the deep pockets help you to overcome some of these concerns, in particular, even if, say, fines that you and I would feel could be significant, could be completely negligible for companies with huge levels of profits, where you basically say, even if I'm caught by antitrust authorities, it really doesn't matter too much. So therefore, this is why I think in the end, the public interest will trigger even more discussions on what antitrust stands for these days.
Right, right. Excellent. Yeah, this has been a great job. Thanks so much for spending time with me.
Well, thank you so much. It's been really fun, and it's also been rewarding to be able to talk about the research in this format. Thank you so much.
Thank you.